What's going on, everybody? Welcome to another Ticker Fee video and welcome to the Ticker Fee family. As you can see, the ticker symbol we're going to be talking about today is NNDM, or Nano Dimensions, and what we're going to be talking about specifically is how Nano Dimension acquires Micromechanics NanoFabrica. So who is NanoFabrica, as well as what are the depository American shares? And then we're going to finish this video off with a chart analysis, price prediction, and how inflation and how it is currently affecting the market. So thank you so much for the support. I really do appreciate it. And if you're new to this channel, welcome, and let's go and get started. Alright, so I like to break down articles. So there's a few things that I've highlighted in yellow and in green. So let's go ahead and get started. So Nano Dimension acquires Micromechanics 3D printing leader NanoFabrica. Now, on April 27, 2021, keep in mind, Nano Dimensions, the leading additive manufactured electronics, or AME, the provider announced today that it has signed and closed a definitive agreement to acquire NanoFabrica, a world leader in technology and turnkey systems for precise 3D micro printing. Now, for those that don't know, Nano Dimensions, one of the key factors that they have in their products and services is going to be 3D printing. So this is not a massive surprise. Now, Nano Dimensions will pay the shareholders of NanoFabrica a total ranging between $54.9 million to $59.4 million. Now, out of that, between $23 million to $27.5 million will be paid in cash. And this is all going to be dependent upon NanoFabrica meeting certain performance milestones and the founders of NanoFabrica continuing to work for a defined period after the acquisition, which happens many times, especially when companies merge. A lot of times, certain individuals will stay to make sure that the company still continues to thrive during that transition. Now, approximately $32 million was paid in American depository shares of Nano Dimension, approximately 30% of which cannot be sold for various periods up to 24 months after closing of this transaction. Now, certain cash payments will be based on NanoFabrica's revenue and gross margin performance in the next 12 months. So what is an American depository share, or ADS? It is an equity share of a non-U.S. company that is held by a U.S. depository bank and is available for purchase by U.S. investors. Now, the entire issuance of shares by a foreign company is called American Depository Receipt, or ADR. Now, while the individual shares are referred to as ADSs, the terms of the American Depository Shares and American Depository Receipts are often used interchangeably. Now, here are the key takeaways for this. Now, it refers to foreign companies that are held by U.S. depository banks and can be traded in the U.S., including on major exchanges. Now, ADS allow foreign companies access to wider investor base and the world's most sophisticated financial market. Now, the main drawback of ADS for investors is that there is still some currency risk, even though they are denominated in the U.S. dollars. Now, here are some of the benefits of ADS. Foreign companies that choose to offer shares of U.S. exchanges gain the advantage of a wider base, which we just talked about. Now, for U.S. investors, ADS offers the opportunity to invest in foreign companies without dealing with currency conversions. Now, here is what the downsides are. There is some currency risk involving holdings ADS. Fluctuations in the exchange rate between the US dollar and the foreign currency will have some effect on the price of shares as well as on any income payments, which must be converted into the US dollars. Tax treatment of the dividends from ADSs is also different. Most countries apply withholding amount on dividends issued for ADRs. This withholding amount can vary. For example, Chile and Switzerland withhold 35%. While France can withhold as much as 75% of the tax on dividends. So these are the benefits and as well as the downsides of ADS. Alright, so there are a few more things that I've highlighted. Now, NanoFabrica scientists and engineers, all of whom are expected to now join Nano Dimension, are leading experts and industry veterans in materials, software, mechanical automation, and robotics. Now, they are continuing to be led by NanoFabrica's two founders, which is Dr. John, who holds a PhD in physics and engineering, as well as in nano-optics. And then you've got Mr. Sheiliff, who worked in HP company for 16 years in R&D. And as well as this individual has registered for over 35 patents under his name. So there's got to be some value there. Then the last thing is this. They've got mutual vision to merge the technologies for the microelectronic 3D fabrication machines. Now, NanoFabrica's micromechanic 3D printing, the future of high PEDs and miniatured high-performance printed circuit boards, and interlaced with micromechanical printing applications to fit the next big thing, which is small. So I just wanted to point that out because I feel like they're going to go from this new established industry to what they say is a 4.0 solution. So I'm super excited and incredible to see how this is going to affect us and see where we're going to be towards the end of this year. Okay, so what I want to present to you is some of the industries and applications that they are providing to some of these specific needs. So as you can see, you've got aerospace, automotive, electronics, optics, semiconductors, medical, education, and consumer products. So working with all these different sectors are going to be great for Nano Dimensions, and so I just wanted to point that out. Alright, so the main question is, why is my stock dropping? Currently it's at $6.87, but not too long ago in February, we're looking at, or at the end of January, beginning of February, we're looking at a high of $17.89. So what is that discrepancy? What is the gap? So here lately in some of my videos, I've been trying to stress the importance of what's been going on currently in the market. So there are a few things that are making it volatile. So the first thing is going to be retail taxes or retail investors. So what do I mean by that? Well, if you're a retail investor and last year was the first time you started buying stocks and you've been making all this profit, you've actually had to pay some taxes. Well, capital gains is not a surprise. We all know about it. But if it is your first time, you are surprised. And so you've got these retail investors who are selling all these stocks, and you see these brand name companies or these retail type stocks that everyone knows about dropping. So that's going to be the first thing. The second thing is going to be the hedge funds. So you've got all these hedge funds that aren't using their big money currently to buy these stocks. They've got all this pressure and all this stress to make quarter after quarter profits. And so when they're looking to see what's going on, they're looking at what's going on in the corporate environment, which is talking about with the infrastructure plan, which is going to possibly change from 21% tax to 28%. So you've got a 7% gap difference between that might affect all the stocks, because once that takes place, you're going to see all the products themselves and the services that these companies provide will continue to get more and more expensive. Then the other thing is going to be the annual report. So you've got Q1 and annual reports from all these name brand large cap companies like Microsoft, Tesla, as well as Google, that's giving you all their current reports. And so even though it might be positive, a lot of these individuals that are looking at these stocks need to see net value as well. So you've got the hedge funds with you've got the financial reports, you've got the retail taxes, and so there's quite a few things that are taking place. So at the end of this video, I'm going to explain as well is going to be inflation. So the difference between inflation and hyperinflation and what's been going on, because we've been affected by it. Now, looking at the stock itself, if you actually see, we've had a support line which has been actually pretty good compared to what it could be compared to other stocks. Now, our support and our resistance is about equaled out so far. Now, if you fast forward to where we're at today, April the 27th, we closed lower than what we opened up at, so we had a red day. Now, the wick there was a lot of movement on the wicks. Now, it's showing that it had 59 million as the volume, so there was quite a few buys and sells. But since then, on April the 27th, which they had Nano Dimensions acquire Micro Mechanics NanoFabrica, which brought the catalyst a little bit higher, it's still closed again lower than what it opened up at, and since then it's still been dropping. Now we've had a new support line, which is going to be $6.63. That's why we were thankfully able to close a little bit higher, which was $6.87, but the volume trade is looking at 12. So we had that catalyst that took place at 59 million, and then you fast forward to today, which is going to be 12 million. So showing that we still have the support and we still have the resistance. Now, between what's been going on with all the catalysts and what's making it very volatile, I'm looking at Q3 and Q4, and we're going to be able to push with the new support line past $7. I'm still looking at between $7.30 and $7.40. Hopefully, maybe at the end of the year, we can even get to $8. And so once then, we can start a new year fresh in January. So we're going to have to see and where that goes from there. With inflation and the effects of the stock in the market, so the growth sector was down today, continuing this teasing pattern. It's going on with the growth stocks. You can just see it. Now, the short-term traders themselves are winning the majority of these trades. And that's what's been going a lot in the stock. Now, during the pandemic, household has been their cash are at record levels. Now, Americans have these saving rates, right, that have continued to stay high. Now, more Americans are slowly spending money, and what is happening is that you're seeing prices go up. Now you are paying for the more basic items that you weren't a year ago. Now, rising consuming prices are in this US chart, which you can see. So the percentage change is an average unit price versus previous year, which is the latest 52-week period ending April 10th, 2021. So groceries has gone up 2.6%. The household care has gone up 5.2%. Baby care is 7%. And then you've got general merchandise, which is going to be 7.1%. Now, also, you're going to be able to look at is going to be the U.S. retail gas prices. Now, with that, if you look at this chart, the gas prices are going from $1.88 to $2.96. Now, a year ago, there was a lot less demand due to lockdowns. Now, when demand completely comes back, you will see that the gas price increases even more. Gas has rose 9% in March alone. Now, if you actually look in California, you'll see with gas prices, it's actually around $4 or even higher, which is pretty crazy. Now, when it comes to cars, used cars prices soar and the sticker shocks may get worse, which is not a surprise if you've bought a car here recently, especially according to this article. As well as if you look at home builders, the cost of material has skyrocketed. So cars have a record demand but limited supplies due to the supply chain issues. And then if you actually look at asset classes such as stocks, home, cryptocurrencies, cost more than they did last year. So the question is, why is it happening? So there is a massive supply chain issues. There's the delay of shipments due to the pandemic with trade. People are going to go out and start spending their savings, which is going to make an option or an opportunity for deflation. Now, if it goes back to pre-pandemic, you will start seeing money flowing around, which is going to be great. Now, look on how the inflation is reported. If you compare April 2021 to April 2020, it appears more inflation. Now, April 2020 was in a deflationary environment. Now, when everything is starting to pick up, numbers appear worse due to this comparison. Now, here's the thing. If you actually compared 2017, 2018, and 2019, that creates a better picture. Now, probably seen that a lot of our articles have hyperinflation, and they are printed on a ton of money. So, obviously, you'll have to see there are these articles that show 12 warning signs of U.S. hyperinflation. So, this is one of those articles. Now, what I want to show you is that there is a massive inflation according to these articles, but banks save more money during inflation and they don't distribute out to the public for liquidity, and that is only needed during a crisis. So inflation is not bad. Hyperinflation, that is where the feds will increase the interest rates, which requires someone to take on more money and more risk. Now, high multiple stocks will go down dramatically during a rapid hyperinflation. Now, a lot of these stocks have factored in hyperinflation, so you're going to as well see that in the stocks. But most value stocks are increased from pre-pandemic highs. Now, during the summer, we are going to see the growth rates go up and up on these growth stocks. Okay, so as well as I want to point out when it comes to inflation or the inflation scare, look at all these articles from 2009 all the way to 2018. You've got inflation scare, crazy but real. My inflation nightmare. Inflation, a high price to pay. So as you can see, through these years, clearly all these stocks have continued to rise and people have been making great profits. But when you look at these articles, you can see that there are people that are trying to put fear into it. So I wanted to point this out because not everybody notices this, especially if this is the first time or the first year that you're going into buying stocks.